So do we have a 2020 recession looming? I don't know. You don't know. No one really knows. But what we can do as investors is prepare today just in case that recession is closer than we think. When it does hit, we want to be ready to take advantage of it so we can profit massively off of it. So in today's video, I'm actually going to give you 3 different tips or tricks or whatever you want to call them to prepare for a recession so that you are able to come out of it much wealthier than you go into it. So hit a like on this video if you're ready for the next recession. Let's try to get this video, say, to 250 likes. Maybe if we hit that, it'll push out the recession even longer. But either way, let's stay strong together and let's get those likes. Alright, getting right into the meat of the video here, the first thing I want to discuss is to start building up a cash position. Now, the most common thing that you're going to hear when recession talks start looming or start coming up is that you should always have a lot of cash ready on the sidelines. But the question is asked over and over and over again, how much cash should I hold? Is it 10%, 20%, 50%, 100%? Should I not invest at all and just hold everything in cash and wait for the next recession? And the answer really isn't something set in stone. There isn't really a one-size-fits-all answer. However, what I want to do is show you what I'm personally doing and what cash position I personally have in my portfolio. To do this, however, there's 2 questions that need to be answered. The first is, what is my holding period? This is important because the longer your holding period is, the less cash you need to have on the sidelines for a possible recession. I believe there's some stat out there that says over a 10-year rolling period, the market has always recovered its losses. But even if that's not entirely true, most recessions have a dip and the stock market usually recovers in about 1 to 5 years after that. So even if you buy, say like today at the peak of the market, but your holding period is a long term, we're looking maybe 10, 20 years out, there's nothing to worry about because time is on your side and more likely than not you will end up massively on top either way. And not to mention that during a recession you will most likely have some sort of income coming in still, so you can go in and average down on all your positions, making it even more profitable when we do exit out of that recession. So if this was a situation that I was in, which I'm sort of in this position for some parts of my portfolio, then I would personally be buying stocks whenever I find a deal and not really worrying about how much cash I'm holding on the sidelines. In fact, the more cash I have on the sidelines, the more opportunity is technically missed. So I try to deploy that capital as fast as possible into value stocks that I find. Now the next question to ask is, do you need this money in your portfolio in the short term? Now I'm talking like, say, 3 years from now. So this is where you need to be more cautious, and this is kind of the situation that I am personally in. Sort of. So if this is the case, what I would say is you want to have around 50% or so of your portfolio ready to liquidate in the next 3 years or so. To do this, you probably want to invest in really low volatile, which also typically means low return equities or bonds or whatever, or just hold cash. Alternatively, if you plan things out properly, you could just continue holding your portfolio the way it is, but then any income you earn from now on, you just kind of have as a cash position in your savings account or even in your brokerage account, but you leave that in cash to build up that cash reserve. So there's kind of 2 ways to approach this. One is to really sell your equities to build up cash. The second is to just continue holding, but any new income that comes in just stays in cash. And this is really on a per case basis, depends how large your portfolio is, depends how big the expense you plan to spend on is. So for example, if you wanted to buy $1 million house in 3 years, you would need, say, 20% down, which is around $200,000. So you need to start planning now to figure out how you plan to get that $200,000 or save that $200,000 in 3 years from now. Maybe that means you sell off some positions. Maybe that means you just continue earning income from your job and just building up that cash position. Either way, you have to start planning early so that you're not stuck in a position later on where you're forced to sell regardless of how the market is doing and possibly take losses on your position. So this is kind of the situation I'm in. I may make a big purchase in the next few years, and because of that, I try to keep around 20% or so of my portfolio in cash. And I have kind of decided as well that kind of moving forward, I will kind of be more cautious on my investments. I'm not going to just throw money in there into stocks that I think are good value. I'm going to wait for great value, and this will actually help me build up even more cash in the next few years. All right, now the second big tip here to prepare for the 2020 recession, if that happens, is to analyze your portfolio. So what I would say is take a hard look at your portfolio, spend a bit of time, look at each of your positions and figure out which companies you actually believe in and which ones you're just holding just because you're hoping for some short-term gains. Just remember that stocks that have weak fundamentals will typically get hit extremely hard during economic downturns like a recession. Now I know this method actually takes a bit of time, especially if you're an individual stock picker, but if you are an individual stock picker, this is something that's expected and you should be devoting time to analyze your portfolio every so often. You want to ideally invest in companies that are undervalued or even fairly valued, and you ideally want to keep a close eye or even exit positions in companies that are overvalued. One way to find out companies that are overvalued is to look at their fundamentals, maybe look at their PE, their forward PE, how their earnings have been going over the last few years, how their revenue has been going over the last few years, and just look through their balance sheet to see if there's any red flags that you see. Then stop and think about this company, not just the stock and the charts. Think about the company itself, what they do, and ask yourself, do you see this company getting through a tough recession? And more importantly, do you see them coming out even stronger after the recession? If you have doubts about this position or you're not sure about this position, then you either need to research the companies more or consider cutting those positions. Now you may miss out on gains if you cut out those positions. This market may continue moving higher, say another 10, 15, 20% from current levels. And if that happens, guaranteed you are going to have regrets or FOMO, fear of missing out. But that's part of investing. You need to have that tough mindset. And once you make a decision, you got to stick to it. You need to be 100% confident in your investments so that when times do get tough and you see your stock drop 10, 15, 20% in just a few weeks, you can go in there and see that as an opportunity and say, you know what, I understand this business. This business is a strong business. I think that it's going to be much, much stronger in the future. So I'm actually going to buy more shares here on this correction. Now, the third thing you can do to prepare for the next recession is to build your sources of income. This is something that's been thrown around, honestly, just everywhere on YouTube, but it is something that's extremely important. You need to make sure that you have multiple sources of income when we do enter the next recession. A recession typically leads to job losses, and if for whatever reason you lose your job, you need to make sure that you are able to still sustain yourself and still have other streams of income where you can still continue building wealth. Having multiple streams of income, sources of income, whatever you want to call it, will also help you get to your financial goals much quicker and will actually reduce your risk during a recession just in case you do hit tough times financially. Now, there are many things you can do to build sources of income. You can, of course, have a job. You can have a side job maybe on weekends. You could also do things like real estate investing if you have the money for that. You can do things like dividend investing, so you can earn dividends from stocks. You can do something like what I do and create a YouTube channel and earn some passive income there. You can do affiliate marketing, drop shipping. There's a lot of different things you can do out there to earn a bit of extra side income to supplement your main source of income. Trust me, people who have gone and started building out their source of income at a younger age, even though it's a lot of work and takes a lot of time, when you fast forward a few years from when they started, you're almost never going to find someone that regretted starting those side businesses or side hustles to create multiple sources of income for themselves. However, on the flip side, you are almost always going to find someone who regrets not starting something, especially if times do get tough. Keep in mind that the wealthiest people in the world have multiple sources of income. They don't just rely on one job to have all their income come in and build their wealth that way. They do diversify their money and their risk, and this helps them get to their goals much quicker. Now, for those of you that are still listening and stuck around for this point in the video, comment down below with the word bonus to let me know that you're still here and you're still watching. Now, as an added bonus, what I'm going to do is actually give you a fourth thing you can do to prepare for a recession. So the fourth bonus tip here is to prepare mentally. So this is not something you can actually materially do, but it is something that I believe is extremely important, which is why I still wanted to include it in this video. You need to start mentally preparing, getting yourself ready for a portfolio that is down 20%, 30%, 50%, and you have to be okay looking at that and living with that. And simultaneously, you need to make sure that you're able to control your emotions with your portfolio. Many people can prepare financially for a recession, build up a massive cash reserve, keep investing in the markets, time in the market is better than time in the market. You hear all these things time and time again. But when times do get tough, most people will cut their losses and sell at the lows. This is when you want to have a tough mindset. You want to go in, ignore the noise, remember the fundamentals, remember the long-term outlook, and just keep buying. Now, it's not going to be easy to see your portfolio down 30 to 50%. If you have a $10,000 portfolio, this means you could be down, say, $5,000. If you have a $100,000 portfolio, this means you could be down $50,000. It's not going to be easy to log into your brokerage account, look at that portfolio, and actually be fine with it. Everyone is going to have some sort of doubt, second thoughts, maybe I should sell out of these positions, but you got to keep reminding yourself, this is just temporary, this is just short term, things will get better, and we will get through this and have massive profits at the end of this, so just stick in there. Just remember, every time the market has a recession, it does recover and does come out stronger, and we make new all-time highs. And this time, it's not going to be any different, no matter what anyone says. I strongly believe that personally, and I think any long-term investor does as well. The way I think about this is pretty logical. There's more and more people that are getting into investing every single day, throwing more money into investing every single day. And 10 years from now, there's going to be a lot more money in the market than there is today. And as a result, the market should be much higher than it is today. Sure, we're going to have some turbulent times during the next 10 years. I'm sure we're going to see a recession, maybe even 2 during the next 10 years. But there's going to be opportunities for us as investors to go in there, buy stocks cheap, and profit massively from them. I know a few of my viewers here on the channel have been investing through the last recession and have bought stocks on the lows during that recession. And you guys will know how much money can be made from a massive bull run if you're able to stick through a recession and keep buying stocks. Comment down below if you're one of these subscribers. But the point here I want to really drill home is to have that mindset. Just remember, you are going to get through this. Recessions are normal, and if you just keep buying, things will most likely work out in the end. Guys, if you enjoyed this video, don't forget to drop a like down below and share this with a friend who is kind of concerned about a recession. I know the markets have been a little rocky recently, but I do believe that we will get through this, whether we hit a recession or not. I want you guys to stay strong, stay invested, and most importantly, have a game plan. Thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one. Peace.